Welcome to today's webinar on construction sector conditions. I'm Haley Shenander of the Federal Reserve Bank of Minneapolis. Before I turn it over to our speaker today, I have a few housekeeping items. Slides for this presentation and a copy of the video link will be emailed to all registered attendees next week. Ron will be entertaining questions at the end of his presentation. If you have a question, please type it in the chat box on Zoom. We'd love to get your feedback at the end of this presentation, so please take a moment to fill out the brief 3-question survey that pops up in your Zoom window when you exit the webinar. And with that, I'll turn it over to Ron.
Thanks, Haley. I appreciate the introduction. I appreciate everyone coming today. I think there's some interesting things to share with everybody regarding the construction sector in the 9th District. So I appreciate everyone taking the time on a Friday to listen in. As Haley mentioned, we'll also be sharing a lot of information after this. So if there's anything that you want to take a closer look at, you'll have the chance afterwards. So before I get started, I have to give you my disclaimer. So the views expressed here are the presenters. Those are mine and not necessarily those of the Federal Reserve Bank of Minneapolis or the Federal Reserve System. So first, before I get started with some of the content, I do want to give a shout out to all the partners and the respondents. So if there are people that have responded to this survey that are here today, I really want to say thanks. This is the largest construction-focused survey among the 12 Federal Reserve District banks. We find this survey exceptionally useful in our understanding of how the construction market is operating right now. It's really a kind of a bellwether sector to us in terms of people's confidence in the future. So we really appreciate the participation, not only from our partners, but from their members. So the way we execute this is we have a lot of partners that are across the 9th District, a lot of construction trade organizations that distribute our survey to their members who respond. And I really just want to say thank you. Without your help, this survey can't go forward. And it really does provide a lot of information, not only to the Minneapolis Fed, but to our partners and their members. And we share this publicly because we really want everyone to understand what the conditions are in this really important sector. And I want to just give a quick shout out. We do have a couple of new partners, the Construction Industry Center in South Dakota and the Home Builders Association in Billings. We got more responses in both of those states, I think largely because we got some new partners in those states. If there happen to be other partners that are other organizations that are listening that maybe are not partners, or you are part of an organization that you think might be interested, I have my contact information at the very end. I would love to get an email from any new potential partners. So let's talk a little bit about the survey itself and some of the particulars. So we conducted this survey in early November through November 15th of this year. We had 311 responses, which is about 25% more responses than our previous survey. So we're really happy about that. And we got better representation across states. We also try to make sure that our composition is pretty similar. So the fact that we got a few more responses, I think most of it was in the residential sector. I think that for some reasons that will become clear. They didn't do as well. And we tend to find that sectors that are maybe not doing as well want to have their voices heard. So we'll talk a little bit about that. But in general, we still see a very good balance among the sectors. And from a firm size standpoint. So we think our results are really quite replicable and comparable to previous surveys in terms of composition. I do want to note, though, that these results are a snapshot. This is not a scientifically sampled survey. So how I generally like to characterize this is these survey results are a pretty good assessment of general conditions and direction. They are not a very exact one. So just please interpret results carefully. Okay, and with that, let's talk about just kind of broadly what are some takeaways. So generally speaking, we're still seeing negative revenue and profit trends. Clearly, that's not a good thing. The residential sector is seeing the worst outcomes of those 4 sectors that I showed you on the last slide. I'll talk more about that, but their results were poorer by a fairly sizable margin. Industrial and infrastructure are doing better, but we are seeing some slowing signs in those sectors as well. Some of the other things that are a little concerning is that the number of new projects out for bid seems to be declining, and backlogs are shrinking as well. There's some of the same challenges. I don't think this is a surprise to anybody that's listening today. High interest rates are a problem for the industry. We're also still seeing high input costs and labor costs. But I would say there is a little bit of good news. I don't want to overstate this, but we are seeing some improvements in supply chain. Price inflation seems to be moderating a bit. Labor demand is still healthy also, and labor availability is getting better as well. Again, I don't want to overstate those, but I'll talk about those in a little bit later as well. In general, results are actually quite similar to the survey we did this time last year. That's both a good and a bad thing. That is when we saw some fairly negative trends kind of take hold, but I would say things don't seem to be getting a lot worse compared to November of last year. In general, the outlook, we're still expecting lower revenues to continue, and the overall sentiment is pretty flat, and I think there's probably a lot of caution in the sector in general. Okay, so let's take a little bit closer look at some of the exact details. So revenue and profit. So first, let me talk about how I orient a lot of these slides for anyone that's new here. For those that have seen this before, just bear with me. In general, I do a lot of time comparisons, and I want to do those to give you a flavor not only of kind of the immediate sense, but also how things have gone over time. So you'll see a lot of these horizontal type charts. Green means good or growth, red means bad or decline, generally speaking. The darker the color, the more on the margins it is. So in general, there's 3 time periods here. I wanted to hear from firms on how the summer season compared to 2022, how the fall season compared to last year, and then what are our expectations coming up. So that goes top to bottom. In general, I think if you look at the very top bar, summer was generally flat. You also have to take into consideration that does not account for inflation effects, in terms of revenue trends. So I would not call this positive. It's the most positive of these 3 markers, but I would say overall things were flat, but things were also really strong in 2022 in terms of general activity. The fall season, you're starting to see some of that slowdown take hold again. Some of that clearly is seasonal, but again, compared to last year, you're still seeing things be a little bit slower than they were, at least as firms reported it, compared to last year. And again, the revenue outlook is a little bit more of the same. Revenue trends not really expected to be very strong. Again, from whether firms are seeing growth or whether they're seeing decline, we're seeing more or saying we're going to see maybe lower revenues going forward compared to the previous year. I also want to give you some idea over time how things look. So we've been asking this revenue question now for some time, and these are the surveys that we've done going back to May 2021. And the thing I want to show you here is that the revenue trend really kind of got started on a negative trend in April of 2022, and with each successive survey, we've seen that revenue trend, that recent revenue trend, get a little bit more negative, unfortunately. So I also, in terms of future revenue expectations, here you see just the past 3 November surveys, and there's kind of good news, bad news here. If you look at, compared to November 2021, clearly the trend is more negative. But if you compare this year's expectations to last year's expectations, I don't want to say there's a lot of improvement here by a long shot, but I would say we're seeing some similar. This is where I was referring to this year's survey showing a lot of similarity to last year, and this is one of those cases. Really not seeing a more negative trend, a little bit more positive trend in terms of what future revenue expectations are, but I would still call this not a great picture. In terms of company profits, we've only recently started asking this question. It's about a year old, and we've seen negative profit trends, mostly because of the higher input costs and other factors that we've seen profit margins really get squeezed. Again, here from a comparison to the November 2022, we're not really seeing anything get more negative. We're seeing some positive here, I think in part because input costs are starting to moderate a little bit. I'll talk more about that. So some of the pressures that they had been seeing are easing. Some other ones are popping up. I'll talk a little bit more about that as well. So in terms of some of the sector breakdown, this is where I think you really start to see some things kind of sift out in terms of who's really seeing the most pressure, and that is in the residential and commercial area. So there's 2 charts here. The first one is the summer revenue trend compared to last year, and then the fall season by sector. And here you can see that residential is seeing the worst of in both areas, both summer and fall revenue trends. We are seeing in the fall that things are slowing a bit in all of the sectors, but if you look at infrastructure and heavy, they are still seeing a positive overall revenue trend in terms of the share of companies seeing a positive revenue trend versus negative, but there is some compression in the shares of both. And I do want to also note, so we only see about a 15 to 20% share of firms that respond that are in infrastructure and industrial, but those firms tend to be bigger firms and they tend to work on much bigger projects in general. So, so you'll generally see that's why some overall spending trends are a little bit more even than if you just thought everything was kind of equal in terms of the four sectors. Here's kind of an example of that. So I always, when I get survey results, we can't put too much faith in them, especially without kind of trying to triangulate with some other information. So I always like looking at some actual data to see how they correspond with what I'm hearing from firms. And we get this data from Dodge Data and Analytics, and here's a rolling 6-month average of the total value of monthly construction starts in the 5 district states that we look at, Minnesota, Montana, the Dakotas, and Wisconsin. And the total value, as you can see, we're seeing some slowing, especially when you think of the fact that this data is not adjusted for inflation. So we are seeing some slowing. So if you look at the total value of construction starts from May through October, there's where you start to really see some additional evidence that residential is slowing. We saw a 16% year-over-year decline over that 6-month period in terms of value. Non-residential also seeing some decline in that commercial sector. And then non-building, we're seeing a lot of federal infrastructure projects and other things that are really keeping a floor under that and still seeing some growth in the non-building sector. Similarly, I like to keep an eye on housing permitting, and here's where again you can kind of see that what firms are telling us are really showing up in the data. So single-family permits on the left, you've seen a pretty steady decline each of the last 2 years. This is data through September of each year. And then if you go in multifamily really held up pretty well last year, but we're seeing an even bigger decline there. The one thing I would say is that I am seeing, so I follow monthly permits on a regular basis across the 9th district, and I am seeing some signs that there's some rebound in recent months. For example, in the Twin Cities in the last 3 months, we've seen about a 60 or 70% increase in the total number of single-family permits year over year in those 3 months. Now, those are from low levels, so I wouldn't want to overstate that as well. But we are starting to see some signs of life in terms of some recovery there. Don't know if that's going to be sustained, but it's at least good news temporarily, and for some places. So some other activity measures that we like to follow. Backlogs, I think, are real important. It kind of tells us what the book of business is going forward. So our firm's going to be staying busy, and what we have been seeing the last couple of surveys is that backlogs are shrinking, especially in residential. So the one on the left looks at it from a sectoral standpoint. The littler chart on the right is the overall, and what we are seeing is that we have seen an increase we're seeing a decrease in total backlogs among all the firms that are taking our survey. That's unfortunate. Again, I think it's likely in part because we're seeing higher cancellations for starters, but we're also seeing new projects. We're seeing the number of new projects out for bid going down. I'll talk about that in the next slide. And all of those things combined, we're seeing more future work getting pulled forward. So we ask about new projects out for bid or requests for proposals and whether or not they're increasing or decreasing or not changing. And here's what, again, from a comparison to 2021, things have gotten significantly worse. But compared to last year, things are roughly the same, even a little bit better for public projects. So in terms of private projects, the bad news there clearly is that we've just seen a very big contraction in the overall activity of private projects out for bid. That's what firms are reporting to us. And we are seeing some of that also in the data. RFPs for public projects, much more balanced. Still on the negative side. I think some of the negative side has to do with the fact that there are residential in that area as well. I think some of the activity for affordable housing may be seeing some constriction simply because that gap financing is more difficult. So we know there are still a lot of challenges in the sector. Let's talk a little bit about that. So we always ask, what are your 2 greatest challenges to your operating capacity and productivity? Higher interest rates, the choice, they're smack in the middle, has seen real significant increase, not surprising, as the Fed has raised interest rates to try to get a hold of inflation. We have seen that that's starting to have a more marked effect among firms reporting that it is a challenge. I would say the couple other things: material costs and labor availability, very sticky problems. I think they look like they're going down. They may be actually, I'll give you some evidence that some of these things might actually getting better. I wouldn't say these things are good yet, though, by a long shot. The one thing that I think has shown real improvement are supply chain disruptions. That's the one in the middle that's seen a very steady decline over the last 4 surveys. So we think that one's real, and that is at least some saving grace for some of the challenges that firms are facing out there. So we also want to know, not only here, what are your challenges, but are things getting better or worse? So this is kind of a, how do you feel like things are moving right now? What trajectory? And in general, I think firms are telling us that most of the big challenges aren't getting better, at least very quickly. I am going to offer you a little bit of evidence that at least the cost inflation and labor are improving modestly. Again, I don't want to say they're good, but I think we are starting to see some improvement. We ask basically about both wholesale pricing and retail. So what are firms paying for goods, for inputs to build a house, to put up an industrial site, and then what are you charging to the client itself? So both wholesale and retail pricing. And I think the really strong trend that you can take out of this is that pricing overall is getting better, both at the wholesale level and the retail level. The problem is I would say these are still pretty high levels. When you still have, at the wholesale level, you still have more than 50% saying they're saying increases of 5% or more. Now that's clearly better, but it is still at a rate that the Fed was paying attention to. And from the retail standpoint, it's typically been that firms are eating some of that increase in prices, so they don't want to pass everything on to. Earlier in the pandemic, we were seeing a lot of just absolute pass through in prices. We're seeing less of that now, so they're eating a little bit more of that price increase, but even those levels have come down from a year and a half ago. Labor demand, I think, and again, some of the good news is that we continue to see labor demand that is still positive. More than half of firms reported that they were hiring, and roughly about 3 in 8 are reporting that they are hiring for new full-time positions. So again, I think that's a real positive sign for the sector in general. We are seeing that the difficulties that we're seeing with regards to interest rates and other things, that they are having some downward pressure on labor demand. And one of the things that I noted in particular compared to November is that the share of firms that reported cutting workers doubled from last year's survey. In general, though, again, because I like to triangulate how exactly what firms are telling me versus what the data is saying, the construction employment itself, it doesn't look like it's seeing much of a slump. The chart on the left is Minnesota employment. So there you have construction versus total employment. Construction has been outpacing total employment very strongly during the pandemic and coming out of the pandemic. The chart on the right is construction for all of the district states. Now, the one thing I would point out, Montana has seen significant growth. They've been really building an awful lot of everything out there, particularly residential. We are seeing a dip in that, but it's still very high, especially compared to total state employment there as well. The one other outlier that I'll just make a note of so people maybe don't misinterpret, North Dakota is seeing a very negative trend, has been. I think that's mostly related to energy markets. Everyone's probably familiar with the Bakken explosion there a decade ago, starting 2 decades ago. I think in general, especially in metro markets, I think you're still seeing fairly healthy construction markets. I think it's mostly related to the energy development, as well as the related kind of spillover effects of energy investment that you're probably seeing more as a result there. So there's been some decline since pre-pandemic, but again, given what's happened in energy markets, especially early in the pandemic, I don't see that trend as maybe as negative as what the chart looks like. I also am kind of interested to see, we always see an increase in unemployment insurance claims around this time of year. So I thought if we're really heading into something different, we should start to see that in some of the unemployment claims. And it really, while there is some increase over 2022, I would not call it dramatic or outside the margins. Continuing claims are a little bit higher, but again, if you the chart on the right, but if you go back and look at what 2019 levels are, they're actually just barely, they're just a shade over what we saw in 2019. So again, I don't see any clear evidence that we're seeing a real shock in anything having to do with construction employment. The fact that there is some slowing overall, though, is we are seeing firms report that the ability to find labor is at least getting better. I would not call it good yet, but the job matching process seems to be working a little bit better because I think for two reasons. There's probably fewer job postings out there, and there are a few more people available. We're also seeing that wages are still remaining pretty strong. So the chart on the right is average wages for skilled trades. Over the past years, is the tan bar, and then expected over the coming year is the right. And what you're seeing is that there's still fairly strong wage growth. It's not very different than what we've seen in previous surveys. The previous surveys is the smaller chart on the left. What you see there is that there is some easing, I would say, of wage increases over the previous reporting period, but not a dramatic one. Excuse me. In part because we are still seeing labor demand, we are still seeing construction activity out there, and I think firms have worked so hard to find their labor that they want to make sure they can keep their labor as well. Hopefully, when things start getting a little bit stronger as well. Now, there is the one thing I will note on the chart on the right, we always ask, what is your expectation for the coming year? It's not unusual for us to see a notable decrease in those that expect the highest level of wage increase. And in this case, I would say that might be very justified because we are seeing slowing. But I also have seen this in the past, and it's not necessarily clear. Like if you look at the chart on the left, it's not clear that the same level of decrease in the high wage increases is very evident in previous surveys. So we don't necessarily see the realization of that expectation, if that makes sense. And finally, we always ask just a general outlook question. And here I would say, again, compared to 2 years ago, things have gotten a little bit more dour for sure. But compared to last year, it's very, very similar. In general, very flat. I think there's probably likely a lot of caution in the sector in general, particularly in residential. We know things are a lot tighter in that sector. You can see that by the outlook here. It's easily the most negative of the four different construction sectors. Infrastructure heavy being the most positive. Again, I think because of the federal programs in infrastructure investment and other areas. So a quick wrap up. So again, revenue and profit trends, they're remaining negative, unfortunately. And we are seeing some of that slowness seep through all the sectors, but residential and commercial are seeing the worst effects of it right now. Future activity is showing further softness. Project backlogs are shrinking, and in part because we're seeing a decline in new projects out for bid, and especially in the private sector projects. Excuse me. Higher interest rates, I think we have to be honest, that they're having a clear impact. That's what firms are telling us. And cost inflation is still problematic, as is wage growth, I think. But we are seeing improvements not only in those two areas, but also in supply chain. So again, hopefully some of these improvements will help the sector see better days going forward. But the outlook right now is flat, and I would say cautious at best. So we are going to go to a Q&A period here shortly, but before I do want to note one important event that we'll be hosting virtually in January. So Friday, January 19th, it's going to be a virtual conference. We run this conference every year, roughly around this time of year. And it's basically an event to talk about the district economy on a state-by-state level. So we're going to talk about current economic and labor market conditions in every 9th District state. And importantly for this audience, our keynote is going to be David Mortensen, who's the chair of Mortensen Construction. I think most of you are very familiar with Mortensen. We're excited to have David. He's going to have a fireside chat with Minneapolis Fed President Neil Kashkari. So I would highly recommend, I think that's going to be a fascinating conversation with Mr. Mortensen and President Kashkari. So I hope you can join us for that. There is a link in the chat box. You also can just you should be able to find this most anytime on our website at minneapolisfed.org. Hope to see you there. And with that, I'll leave this up just for a little bit, but Haley, I'll turn it over to you to see if we have any questions.
Great. Just as a reminder, if you have questions, please type them in the chat box on Zoom. So let's start with this one. Someone asked, you've told us a lot about residential construction. What might be some of the reasons for softness in commercial activity?
Right. So in terms of commercial, I'll throw out one caveat first, in that a lot of the data that I look at a local or regional level, not every municipality labels multifamily as commercial or residential. I think some of the reason that we're reporting non-residential are reporting a slowing in that area is that many people consider multifamily as not necessarily non-residential, but commercial, and that's kind of the same category. And so I think there's part of that. I also think we are seeing a slowing in industrial spec building. So during the pandemic, we saw a really big push in industrial warehouse construction. We are hearing that market is slowing a little bit, especially the speculative market. So I would say those are two areas that I think we're starting to see a little bit of slowing in terms of projects that are out there and how busy some of those contractors are in those markets.
Great. And you touched on this a little bit earlier, but is there a link between the decline in revenue and potential job losses?
I'm sorry, excuse me. Could you give me that question one more time?
Yep. Someone was wondering if there is a link between the decline in revenue and potential job losses.
I don't think there's any question. When firms see a loss in revenue, I think they have to start thinking, okay, how do we manage our profit margins better? And I think for that to affect employment is a very natural link. But as I mentioned earlier, we've heard not only from in the construction sector, but really from firms everywhere, trying to get the right talent is so difficult that I think what I've heard is there are more businesses that are willing to hang on to employees longer than they otherwise might in an environment where revenues aren't what they hope. So I think I don't think it's as strong of a link as it was in the past in terms of lower revenues, lower employment. I think that's still a very logical conclusion that firms that are seeing lower revenue are more likely to see some job loss.
Got it. Someone had a clarifying question. They were wondering, is multifamily in the residential or commercial sector?
Again, we don't make this explicit in the survey itself, and even at the data gathering level, not everything is always marked the same. But in general, you are probably checking both residential and commercial if you are working in multifamily.
Mm-hmm. Someone else asked, is any growth in construction hiring linked to levels of experience? Are these new people in the trades or without experience?
I think there are, they're probably both, and I'm not the best person to answer this question, actually. My sense is that more firms are willing to take, I don't want to say chances, they're more willing to consider labor with less experience in general because it's difficult to find labor. All things being equal, firms clearly want experience. But I do hear more and more anecdotes about firms being willing to train, which is kind of what you would expect in an environment where labor is tight. More firms are willing to invest in training and other things in order to bring new people into the market. That doesn't mean that it's worked well, but as you see, it's working because you're seeing employment in construction grow faster. We are also doing some work looking at, one of my colleagues, Tuan Tran, is actually looking at apprentice programs just to see how those are responding to labor demand in the construction sector. So we'll have something out either in December or January on that. So you might be something that we can pass along to listeners as well.
Great. Thanks, Ron. It looks like we're right about at time, so that'll be our last question for today. Thank you so much for joining us, everyone. More information will be on a follow-up email to this event. And again, please join us for our 7th Annual Regional Economic Conditions Conference on January 12th, featuring Mortenson Construction Chairman David Mortenson. And with that, I hope everyone has a great day.